What are index funds? A beginner's guide to investing. What are index funds? An index fund is a type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a specific market index, such as the S&P 500, the Dow Jones Industrial Average, or the Nasdaq 100. Rather than having a fund manager select individual stocks, an index fund automatically invests in the stocks that make up the index it tracks. How do index funds work? The goal of an index fund is to mirror the performance of the index it follows. For example, if you invest in an S&P 500 index fund, your investment will automatically be spread across the 500 companies that make up the S&P 500. The value of the fund goes up and down as the value of the underlying stocks changes. Key features of index funds. Diversification. Diversification means spreading your investments across a wide variety of assets to reduce risk. By investing in an index fund, you're automatically diversifying because the fund includes multiple stocks across different sectors, like technology, healthcare, finance, etc. Missia. For example, an S&P 500 index fund gives you exposure to 500 different companies, which lowers the risk compared to buying shares of a single company. Low-cost investment. Index funds are typically very low cost compared to actively managed funds. This is because they simply track an index, requiring little management. The fund's expense ratio, the annual fee charged by the fund manager, is often much lower than actively managed funds, meaning more of your money is working for you. Passively managed. Index funds are passively managed, meaning there's no fund manager picking stocks. The fund simply tracks an index, making it a hands-off investment. This is different from actively managed funds, where fund managers try to beat the market by selecting stocks they believe will outperform. Consistent market returns. 1. Index funds aim to match the returns of the market, not outperform it. Over the long term, markets tend to rise, despite short-term fluctuations, so index funds often provide solid returns, especially over decades. Since they're designed to match the market's performance, index funds offer consistent long-term growth, which makes them ideal for long-term investors, like those saving for retirement. Advantages of index funds: low fees. As mentioned earlier, the passive management of index funds leads to lower fees. Even small differences in fees can add up significantly over time. 2. Diversification. By investing in a broad index like the S&P 500, you automatically diversify your portfolio without needing to pick individual stocks. 3. Simplicity. Index funds are simple to understand and use. There's no need for complex research into individual companies. Just invest in the fund and you're tracking a broad market index. 4. Long-term growth. Historically, market indices like the S&P 500 have provided positive long-term returns. While there are dips and crashes along the way, the general trend is upward, making index funds a good choice for long-term investors. 5. Automatic rebalancing. The companies in the index will be updated over time as companies are added or removed. The fund automatically rebalances itself to track the index, so you don't need to worry about manually adjusting your portfolio. Disadvantages of index funds. 1. Limited potential for outperformance. Since index funds are designed to replicate the performance of the index, they can't outperform the market. If the market has a down year, your investment will also likely see a decline. 2. Lack of flexibility. With index funds, you're tied to the stocks that make up the index. You can't pick and choose which stocks to include or exclude, unlike actively managed funds where the fund manager selects stocks. 3. Market risk. Like all stock market investments, index funds are subject to market risk. If the overall market or the index you're tracking takes a downturn, your investment will likely follow suit. Popular types of index funds. S&P 500 index funds. The S&P 500 is one of the most widely tracked indices, representing the 500 largest companies in the US. By investing in an S&P 500 index fund, you're getting exposure to some of the most established companies like Apple, Amazon, and Microsoft. 2. Total market index funds. These index funds track a broader range of stocks than just the S&P 500. A total market index fund includes small cap, mid cap, and large cap stocks from different sectors, providing even more diversification. Bond index funds. Instead of stocks, these funds track a broad range of bonds. These can be government bonds, corporate bonds, or municipal bonds, depending on the specific index. 4. International index funds. These funds track international stocks, providing exposure to markets outside of the US. This can be a good way to diversify your portfolio globally. 5. Sector-specific index funds. These index funds focus on specific sectors of the market, such as technology, healthcare, or energy. If you want to invest in a particular sector, You can buy an index fund that tracks that industry. How to invest in index funds. 1. Choose your index fund. Select an index fund based on the market index you want to track, e.g. S&P 500 total market bonds. They look at different fund providers like Vanguard, Fidelity, Schwab, and iShares, which offer popular index funds. Open a brokerage account. To invest in index funds, you need to open a brokerage account with a reputable platform. Many online brokers offer commission-free trading on index funds and ETFs. Start small and invest regularly. Index funds are great for dollar-cost averaging, a strategy where you invest a fixed amount of money regularly, regardless of market conditions. This helps smooth out the ups and downs of the market. 4. Long-term focus. Index funds are ideal for long-term investors. Because they track the market, they tend to perform best over extended periods of time. Stay patient and avoid making frequent trades. Don't forget to subscribe for next content.